Thank you, Glenn, members of the Economic Club of New York and fellow New Yorkers. I say fellow New Yorkers because that was the salutation of my last and only previous speech to the Economic Club of New York, delivered more than 30 years ago. I'm reminded, Tim, you had the honor of addressing this place 3 years ago. In another 27 years, they may invite you back. In any event, for me, the timing of that earlier speech was auspicious. It was true that I was then a newly minted president of the Federal Reserve Bank of New York. And coming back to New York, I naturally shared the intense concern that this great city at that time was unable to finance itself. There was a parochial concern about what would happen to New York, but there was also a widespread concern that a default by New York might spread a sense of financial crisis to what was then an already weakened, recession-weakened economy. And there were calls, urgent calls for the Federal Reserve to step in, to resort to a long dormant emergency lending authority enacted in the depths of the Great Depression. Those calls were resisted. The idea was that discipline would be enforced and any precedent to bail out a large but irresponsible borrower would be avoided. As a result, the city had to declare a moratorium on its short-term debt. But eventually, the federal government, after a very contentious political debate, did provide limited liquidity support, highly conditioned. And it didn't take too long for the city, with new management and the installation of strict oversight and budgetary controls, to regain its financial footing. You know the rest of the story. It's come to flourish as a world financial center. Now that may sound like ancient history to most of you. It's more evidence of my age than of any current relevance. However, it did occur to me in thinking about this occasion that some of the differences and some of the parallels to today's financial turmoil are relevant. Until the New York City crisis, the country had been free from any clear sense of financial crisis for more than 40 years. In contrast, today's financial crisis is the culmination, as I count them, of at least 5 serious breakdowns of systemic significance in the past 25 years. I know the arithmetic, it's one on the average every 5 years, and they have not been confined to the United States. It seems to me that is warning enough that something rather basic is amiss. Over that time, we've moved from a commercial bank-centered, highly regulated financial system to an enormously more complicated and highly engineered system. Today, as you know, much of the financial intermediation takes place in markets beyond effective official oversight and supervision. And it's all enveloped in unknown trillions and trillions of derivative instruments. It's been a highly profitable business. Finance has accounted recently for 35 to 40% of all corporate profits, way above normal relationships. And I have to say, it's very hard to argue that the new system has brought exceptional benefits to the economy generally. Economic growth and productivity in the last 25 years has been roughly comparable to that of the 1950s and 1960s. But there is a difference. In the earlier years, the prosperity was much more widely shared. The sheer complexity, opaqueness, and systemic risks embedded in the new markets, complexities and risks little understood, even by most of those with management responsibilities, has enormously complicated both official and private responses to this current mother of all crises. Even previously normal trading relationships among long-established institutions are questioned. What has plainly been at risk is a disorderly unraveling of the mutual trust among respected market participants upon which any strong and efficient financial system must rest. Simply stated, the bright new financial system, for all its talented participants, for all its rich rewards, has failed the test of the marketplace. To meet the challenge, the Federal Reserve has judged it necessary to take actions that extend to the very edge of its lawful and implied powers, transcending in the process certain long-embedded central banking principles and practices. The extension of lending directly to non-banking financial institutions under the authority of nominally temporary emergency powers will surely be interpreted as an implied promise of similar action in times of future turmoil. What appears to be in substance a direct transfer of mortgage and mortgage-backed securities of questionable pedigree from an investment bank to the Federal Reserve seems to test the time-honored central bank mantra in time of crisis. Lend freely at high rates against good collateral, tested to the point of no return. The implications of these decisions and the lessons from the unfolding crisis itself surely deserve full debate and legislative review in the period ahead. It's certainly right, in this instance, the Federal Reserve acted with the full support of the Secretary of the Treasury. In their technical details, the issues are terribly complicated. And that's true in large part because of the mind-bending complexity of the world of derivatives and securitization. The one reflection of that keeps coming back to my mind is that I'm told there are 45 to 50 trillion credit default swaps outstanding, which is a large multiple of the number of credits outstanding. There are also cross-cutting bureaucratic and political concerns. Political concerns at the high level of the proper use and allocation of government power, and at the low level of embedded economic interests and lobbying. In sum, it all adds up to a clarion call for an effective response. Now, before turning to the specifics of that needed debate, I want to emphasize we're not dealing simply with problems of financial structure and regulation, or repairing or papering over weak links in the markets, or realigning supervisory responsibilities. Financial crises typically emerge after a self-reinforcing process of market exuberance marked by too much lending and too much borrowing, which in turn develop in response to underlying economic imbalances. The New York City case was illustrative. The city had spent beyond its means for years. Aided and embedded by local banks, a seemingly profitable but rickety financial structure was built. It was dependent on the rollover of short-term financing and rested on the unspoken presumption that major cities don't go broke. That was child's play relative to recent years. Now it's the United States as a whole that become addicted to spending and consuming beyond its capacity to produce. The result has been a practical disappearance of personal savings, rapidly rising imports, a huge deficit in trade. And of course, the process has been extended and aided and abetted by the willingness of other countries, foreign investors, businesses, and governments to close the gap by buying our Treasury securities, by directly or indirectly financing our home buyers as well as our banks, and increasingly by buying into our businesses. It all seemed so comfortable. There was no pressure for change. Not from Washington, that was spending money and keeping taxes low. Not on Wall Street, that was wallowing in money. Not on Main Street, with individuals enjoying easing credit and rising house prices. Not abroad, certainly not in China or elsewhere, dependent upon booming exports and content to build huge financial reserves. But in the end, just as in the case of New York, no financial legerdemain could long sustain the unsustainable. A breaking point, typically not anticipated, appears, in this case triggered by some softening of the housing market. The excesses of the subprime mortgage were exposed, doubts about financial value spread, and adjustments, painful, but I would say necessary adjustments, are forced on the economy. Now, a second generic point is worth emphasizing. We lose sight of it. Financial crises have been a recurrent feature of free and open capital markets, not least in the United States. The 40 years of relative tranquility were the exception, not the norm. Any return to heavily regulated, bank-dominated, nationally insulated markets is pure nostalgia, not possible in this world of sophisticated financial techniques made possible by the wonders of electronic technology. Markets are international. So are businesses. So are individuals. We cannot regulate and supervise without taking account of and even learning from practices elsewhere. But it's equally compelling that a demonstrable, fragile financial system that has produced unimaginable wealth for some, while repeatedly risking a cascading background of the system as a whole, does need repair and reform. The nub of the problem is that the inherent risks involved in financial intermediation, a process vital to the success of any free economy, must be examined. On the one hand, there are those who need funds, reliable long-term funds, to build businesses, to buy homes, to finance an education, or whatever. On the other hand, many of those with available funds insist upon safe, highly liquid assets for their money. Reconciling those different requirements inherently involves uncertainty and risk, credit risk and maturity risk. Now, absorbing those risks was once largely the role of commercial banks, savings institutions, and insurance companies. Typically, those institutions were subject to rather comprehensive regulation, and the banks, of course, also had access to an official safety net in times of stress. And in recent years, happily, the banks have built substantial capital. The business model of those institutions rested on the continuity of customer relationships, implying some cushioning of the impact of market volatility. In the new paradigm, the intermediation process has increasingly become the domain of the open market. And the general idea is that the inherent risk can be minimized by unpackaging the institutional relationships, separating maturity and credit risk, slicing and dicing so that those risks can be shifted to those most willing and capable of absorbing them. Trading would be encouraged by sophisticated packaging of obligations and by developing derivatives, replicating one characteristic or another of the financing relationship. Derivatives that have taken on a trading life of their own. I think it's fair to say the liquidity of active markets has also encouraged thin capital positions and high leverage. Now, the intellectual rationale was to encourage arbitrage, to close inconsistencies in pricing, to enhance market efficiency. It's efficient in theory. In practice, it has lacked two practical imperatives in the lending process. One is the clear responsibility of a lender for judging the creditworthiness of a loan. The second is the ability of the purchaser in the secondary market to itself appraise the nature and value of the credits it's acquiring. The first of those requirements has clearly been undercut by the tendency to package and sell a loan promptly after its origination. To the extent those obligations are by a commercial or investment bank, the practice can at least be reviewed and disciplined by a relevant supervisory authority. For instance, one possibility by market practice or official requirement in the future would be to insist on the retention by the originator of a significant part of the loan or loan packages. In the domain of the secondary market, the principal gatekeepers have been the few credit rating agencies, each of which has a certain status by means of SEC recognition, as well as by means of years of experience. And I think it's fair to say those proud agencies have a strong interest in maintaining their reputation. I'm sure the next page says. They have a strong reputation to protect. However, it appears that their approach toward rating complex packages of mortgages and loans has suffered not only from the appearance of conflicts of interest, but arise from the common difficulty of much financial engineering, the sheer complexity of it all. Mathematical modeling, drawing strong inferences from the past, has demonstrably failed to anticipate unexpected events of potentially systemic importance. The commonly cited 2 sigma or once in 50-year events have materialized too frequently to validate that approach. Part of the problem, as I understand it, is that mathematical modeling simply cannot deal with markets, where it is not random or physically determined events, but human instincts that cause self-perpetuating waves of unwarranted optimism or pessimism. The combination of herd behavior, opaque loan characteristics, and breakdown of market functions at time of crisis has raised important questions about the characteristics and usefulness of mark-to-market accounting, particularly its extension in uncertain and liquid markets to what is euphemistically known as fair value accounting. That is too complicated a subject for me to linger on today, but suffice it to say there cannot be much doubt that mark-to-market is an essential discipline for trading operations, for hedge funds, for other thinly capitalized financial firms. What's at issue is the extent to which it is suitable for regulated, more highly capitalized intermediaries, including commercial banks, their ongoing customer relationships, the value of which is not automatically correlated with reversible swings in market interest rates, cannot be easily reduced to a market price or a mathematical model. Now, I know very well that the seemingly simple approach of fair value accounting is a highly complex matter extending beyond financial markets. As it should be, resolution of these questions is in the hands of independent standard setters. I'm encouraged that the issues are under review, and I trust that minds are not closed as to the appropriateness of mark-to-market under particular circumstances. Another highly significant area of concern has been the practice of important commercial investment banks to move certain sponsored and related operations off balance sheet. That has been surprising to me, at least, in light of the well-publicized problems of Enron and other industrial companies. Experience has again demonstrated that off balance sheet cannot be the same as out of mind or out of responsibility. Too much is at risk, both financially and reputationally. Now, that recitation of particular market vulnerabilities or supervisory lapses, of failures to close gaps or end disagreements among regulators is not surprising. In the United States, informed observers, market participants, officials themselves have long been aware of fragmented responsibilities, competing and overlapping institutional objectives, and ingrained resistance to change. Established agencies simply haven't been able to keep up with all the complexities. The drumbeat of lobbying pressure has not been for more effective supervision. To the contrary, it's been, among other things, fear of allegedly heavy-handed and intrusive official intervention damaging to the competitive position of institutions operating in international markets. And perhaps most insidious of all and discouraging discipline has been the pervasive compensation practices. I know it's a long and well-known story, and I won't go into it in detail, but in the name of properly aligning incentives, There are enormous rewards for successful trades and deals and for loan originators, but the mantra of aligning incentives seems to be almost entirely lost in the failure to impose symmetrical losses, or frequently any loss at all, when failures ensue. The point is made time and again, yet with rare exceptions, compensation committees and their consultant acolytes seem unable to break the pattern. Well, far from complete, I said enough to confirm that reform, intelligent reform, will be a lengthy and arduous practice. I particularly welcome Secretary Paulson's leadership in setting out a broad vision of one logical direction for change. Congressional leaders and others are preparing legislative proposals. It's all very useful, but it's going to take time to debate and mature. Meanwhile, we're dependent on ad hoc approaches, making do with and hopefully making better what we have. And in the process, we need to take care that immediate decisions don't inadvertently prejudice more considered approaches. Now, it's clear the immediate response to the crisis has been resort to untested emergency powers of the Federal Reserve. Out of necessity, sweeping powers have been exercised in a manner that's neither natural nor comfortable for a central bank. As custodian of the nation's economy, the nation's money in particular, the Federal Reserve has a basic responsibility to protect the value of the currency and resist chronic pressures toward inflation. It is granted a high degree of independence in pursuing that responsibility. But at the same time, the Federal Reserve should be removed from and seen to be removed from decisions that seem biased to favor particular institutions or particularly sensitive constituencies. Housing is certainly a sector politically sensitive as well as economically important. So I ask myself, why? Why, in the present circumstances, is so much of the burden of restoring liquidity on the mortgage market placed on the Federal Reserve? There are, after all, very large, long-standing institutions, you know them, Fannie Mae, Freddie Mac, and the Federal Home Loan Banks, created by law explicitly to nurture and support the mortgage market they have come to dominate. They have long enjoyed direct and indirect government support. Until now, Fannie and Freddie stockholders and executives have been generously rewarded. Existing law provides for direct government financial support, which could include fresh capital in time of need. Yet given the illiquidity of mortgages, including their own mortgage-backed securities, it seems to me they've been remarkably passive until very recently. I well understand that managements feel a fiduciary duty to their stockholders. But if that duty, in the face of a national crisis in the mortgage market, and their own statutory purposes is the overriding criteria, we can logically ask, what is the rationale for their existence as a government-sponsored and subsidized agency? If instead it's simply a matter of the budgetary consequences of overt government support, those consequences are only hidden by Federal Reserve mortgage acquisitions, not avoided. Somehow, the proper structure and role for those organizations in the face of a crisis playing out in their own front yard, needs to be reconsidered as part of financial reform. In the here and now, if the illiquidity of the mortgage market is the crux of the problem, the use of existing institutions would be quicker and more effective now than building a new channel for government assistance. At any rate, the crisis is simply too threatening to rule out the possibility of government support may be needed. Now, there is quite understandably a great deal of attention being paid to the future role of the Federal Reserve as lender of last resort, regulator, and supervisor, and it won't surprise you to know that's an area in which I happen to have some strong views. The Fed, by reason of its mandate, its prestige, its perceived competence, and most importantly, because it's called upon to lend to troubled banks, is advantageously placed to exercise strong and effective oversight of the financial system. Well, that was a simple and straightforward proposition when commercial banks over which the Federal Reserve had direct authority were in fact the systemic heart of the system. Recent developments have affirmed that those institutions with relatively strong capital positions still are crucial in absorbing risk when the system is under pressure. But now we are faced with further extending and clarifying the Fed's regulatory and oversight responsibilities to investment banks, or beyond, or conversely changing direction toward a new and presumably more consolidated regulatory authorities. The answer to those questions won't come easily, but they must come. Recent developments do certainly justify a sense of urgency, permitting the Congress and a new president to cut through the entrenched political and institutional resistance to change. So let me just say, in dealing with the challenge, a number of points seem to me of fundamental importance. One is the role of the Federal Reserve as lender of last resort and as regulator does need clarification. Those functions are inextricably linked to the extent particular institutions are protected by borrowing privileges. The plain implication of recent actions is that in time of stress, investment banks deemed of systemic importance ought to be so privileged. But how is that universe to be defined? And unless the Federal Reserve's initiative can be contained to a single aberrant incident, which seems quite unlikely, a direct responsibility for oversight and regulation follows. I don't see how that responsibility can be turned on only at times of turmoil, in effect when the horse is left to barn. If the Federal Reserve is to reign further, to have clear authority to carry effective umbrella oversight of the financial system generally, internal reorganization will be essential. Fostering the safety and stability of the financial system would be a heavy responsibility, paralleling that of monetary policy itself. Providing direction and continuity will require clear lines of accountability, running, for instance, to the Vice Chairman of the Board and to relevant Reserve Bank presidents, all backed by a stronger, larger, highly experienced, and reasonably compensated professional staff. Alternatively, a case can be made for consolidating all supervisory and regulatory responsibilities for safety and soundness into a single superagency. While starkly contrary to the American tradition of more specialized agencies, it is the path taken by the UK and a number of other countries to assure consistent and effective coverage. However, as recent UK experience emphasizes, close liaison and cooperation with the central bank would be absolutely essential for anticipating and managing crises. Now, I well understand no one will benefit from regulation and supervision which is unduly intrusive and arbitrary. Venture capital and equity funds have been two successful, creative, and valuable parts of American capital markets. And by their nature, they're dependent on strong and sophisticated investors, so systemic implications of failure of particular funds is unlikely. Consequently, the case for official liquidity support or direct regulatory intrusion is weak. Hedge funds are another story. When managed carefully, they may add to the efficiency of markets. However, the potential for trouble has been amply demonstrated, particularly when those funds are sponsored by banks or investment banks. Consideration needs to be given to ways and means of damping excessive leverage, possibly through the influence of their prime brokers. Similarly, banks in their lending practices need to resist the dangerous and excessive leveraging of businesses acquired by equity funds. The potential for conflicts of interest strongly suggests the most careful consideration of the governance structure of equity and hedge funds be given, including their independence from bank sponsorship. In a globalized world, regulation and supervision cannot usefully proceed in isolation. That's been broadly recognized in work toward common capital requirements for banks, toward international accounting standards, toward more disciplined auditing, and perhaps most critically, toward the development of more effective settlement and clearing arrangements for derivatives. The work already underway in those areas under the auspices of the G7 or otherwise is encouraging. Financial regulation in general, competition and regulatory laxity cannot be a tolerable approach. And I must say, I have talked to some European politicians and regulators recently, and I do not fear that they are going to be softer on regulation than in the United States. Now, I am constitutionally unable to end these remarks without re-emphasizing the point with which I began. Financial crises are most damaging when underlying economic forces are out of kilter, when the bursts of self-reinforcing enthusiasm or fears take hold. It's the basic responsibility of the central bank, most decidedly of the Federal Reserve, whose influence spreads worldwide, to balance and moderate those forces. That's a tough job, particularly when the markets are in turmoil, when concerns about recession are rife. Then the temptation is to subordinate the fundamental need to maintain a reliable currency worthy of trust and confidence at home and abroad. Let me remind you that the dollar, after all, is a fiat currency, backed only by the word and policies of our government, policies exemplified by an independent central bank committed to maintaining price stability. The apparent pressure on the Federal Reserve to take many billions of uncertain assets into its own balance sheet raises questions that must be decisively answered by demonstrating the commitment to deal with emerging inflationary pressures. All of that is more important in the midst of the weakness of the dollar internationally and our continuing heavy dependence on foreign capital. Well, let's, at the end, not lose sight of the silver lining. What can be the positive outcome of all the turbulence and torment? The excesses of the market are surely being penalized in terms of huge losses of money and prestige. The transient pleasures of extreme leveraging have been exposed. By force of circumstance, the nation's spending and consumption are being brought into line with our capacity to produce. The need for regulatory reform is broadly recognized. We have the opportunity to lay the foundation for a new period of sustained growth and stability, and I trust we will seize that opportunity for the benefit of this city, this country, and indeed to global finance, which is still so dependent upon American example and leadership. Thank you very much.
Thank you very much for those remarks. As is our tradition, we do have two distinguished club members as questioners. Pete Peterson, who is the co-founder of Blackstone, a former Commerce Secretary and a former chairman of this club, and Ed Hyman, an eminent Wall Street economist and chairman of ISI Group. Pete, the first question is yours.
Thank you. Mr. Chairman, I've known you for over 35 years. And during all of those years, I've known you to be a man of high principle. And as a founding director of the Concord Coalition, I know you have a principled view of the critical importance of long-term fiscal responsibility. Yet at a recent meeting that I understand was public, my wife, a card-carrying Democrat, heard you make a strong statement in support of Barack Obama's presidential candidacy. Now, I don't know the truth of it, but some say he has the most liberal voting record in the Senate. The obvious question is this: do you feel that the senator has some special attributes, like his presumed ability to unify the country, that might transcend the principle of long-term fiscal responsibility? Or is there a relationship between your support of Senator Obama and your commitment to long-term fiscal responsibility?
Well, I will make a great confession in this small group that I did. I thought we weren't supposed to talk about political matters here, but this is just...
You and I have never done what we should have done.
This is an analytic matter.
Yeah.
This is non-political. Some time ago, I did indicate my support for Barack Obama. My confession is I had not long studied his economic program and his voting record in the Illinois legislature. Let me make that clear. Nor did I long examine his opposition's voting record on these matters or their economic program, neither of which were very clear at the time. What I do have is some fairly strong feelings, and I don't like the direction that this country has been going in for some time, in many directions. Economic may be one part of it, but it is only a small part of the problem in this country. Let me give you one little symptom of a lot that's wrong. People have taken surveys of American opinion every year for years. One of these things where they ask the same question. Do you trust your government to do the right thing most of the time? Not a very tough examination. That used to be 20 or 30 years ago, we first met, the positive response was 70%. Now the positive response is 25 to 30%. I think that tells you something. The quarreling in Washington, the inability to get things done, the amount of money being spent to affect political outcomes or to create political roadblocks is, I think, damaging the ability of this country to meet the very huge problems before it. Whatever it is, foreign policy, global warming, Medicare, medical expenses, medical programs, even something as simple, straightforwardly as Social Security that you've been talking about for 5 years and nobody does anything. That's got to change. And it seems to me the kind of comments that Barack Obama was making, and if you read his books, it's consistent, and they go back for some period of time, is a recognition of those problems and a recognition that that takes a change in the political climate in this country and the mutual commitment and confidence of citizens in all directions. And when I look at the various candidates, it seems to me that he is best able to achieve that purpose of reaching out with some hope of restoring confidence in the American public. And I would just make one other comment which has struck me when you looked at those early election returns in Iowa or elsewhere. To exaggerate a bit, everybody under 30 was voting for Barack Obama. Everybody over 60 was voting for Hillary Clinton. You ask yourself, where does the future of the country lie? I think the answer is obvious.
Mr. Chairman, even if it's a poetic, let me wish you a happy 80th birthday.
Okay. I've got a hope for the economic club, if I may say. I'd forgotten that this is supposed to be a birthday party. My birthday was 8 months ago. But I wonder if you could arrange another dinner for me next year. Maybe we can celebrate my 79th birthday and we'll go backwards.
So thank you for meeting with us, and thank you for delivering such a thought-provoking and substantive speech. Thank you very much. My question is, what are your views on the inflation outlook?
Pardon me, where?
What are your views on the inflation outlook?
Well, my views of inflation is that it's a bad thing.
We're well aware of that.
And I think we have to keep making that clear. But what concerns me about the present situation, of course, it's very difficult. But I have reached a certain age where I can remember quite a few things, and there are some resemblances between the present situation, I'm afraid, and the early 1970s, not in the late 1970s when inflation really got started. But, you know, there was some fear of a recession. The oil price went skyrocketing up. The dollar was very weak. Commodity prices went up. And there was some understandable, I was there. I was in the government. I wasn't in the Federal Reserve, thank God, but I was in the government, and the answer you got was, well, you know, the oil price will come down. It's temporary. It's a special circumstance. Soybeans, remember, soybeans skyrocketed. We put an export. We prohibited exports of soybeans for a while. It sounds like rice today. But you found out that once that process got started and the extremes of those prices did come down. But the sense of some continuing inflation began to get built in. And you know, we had great hopes of having killed that a while ago. And I don't know what the state is of inflationary expectations now. I don't think they're radical the way they were in the late 1970s, but I think we're at a point where we have to worry about it. And that cannot be excluded from policy considerations.
Okay, Pete, the last nonpartisan question goes to you.
Mr. Chairman, in times past, you have said that there's a 75% chance of a dollar crisis within 5 years. What are the likely scenarios that might lead to such a crisis? What would such a crisis look like, and what would its implications be? And what might we do to prevent one? Or do you believe we're already in a dollar crisis?
I think that's a very simple answer, Pete. I think I said crisis time, not dollar crisis. I said it about 4 years ago, and we're in it. You don't have to predict it, you're in it.
There we have it.